Well, Jersey-based active investment manager Ashburton has recently revealed its investment outlook for the coming year in terms of overall asset allocation and strategy outlook, alongside views on Europe, the US and Asia. Tristan Hanson, manager of Asset Allocation and Strategy over at Ashburton, joins us now to share his macro view on world markets and economies. Thanks so much, Tristan, for joining us this afternoon. Well, first of all, when it comes to 2010, the prominent theme that seems to be cropping up more and more is that economic recovery may well be stronger than many had initially anticipated. Yes, the pace is still being questioned, certainly some saying that it may well be slower, but the recovery getting increasing, or that whole story getting increasingly louder. Just what's your view on the global economic story as it stands right now?
I think that's absolutely right. I think that the most likely scenario is that the recovery around the world is going to be much better than most people expect. I think the big area of surprise in particular is going to be the US economy. There's still a large number of people out there very worried about a double-dip recession. Their view is that the recovery we've seen to date has been purely stimulus-led. Once that stimulus starts to fade away, then we're at risk of a double dip. I think the more likely scenario is that the US economy is going to transition into an income and jobs-based growth scenario, a pickup in business spending as well. And I think growth in the US is much more durable. For 2010 at least. There are question marks further on down the line, but at least for the next 12 months, I think those that are more cautious are going to be surprised by the strength of the data.
Having said that, though, we do seem to have country-specific risks rising in both developed and emerging markets. So the broad stroke perspectives, one would assume, while they are there, they're really being interrogated, one would assume, more thoroughly than had possibly been in the past, where it's become more country-specific right now, that focus when making investment decisions.
I think that's absolutely right. I mean, and while I think the broad-based picture is one of recovery in a strong global environment, there are things to be worried about. Public finances are not in good shape in a number of countries, notably in the developed world and not the developing world. So that is a major issue. And then for a number of countries, if we look at emerging markets, the concern will be, are they going to tighten stimulus? Are they going to take the punch bowl away? And you see some evidence of that in China, evidence of that in India as well. And those broad trends will create country-specific risks around the world.
So let's use China as an example then. I mean, if we focus in on some of the development we're seeing in Asia, certainly bolstering much of the positivity about the macroeconomic picture for China specifically would be the outlook you've just painted for the US, that consumer demand really driving a lot of that economy. What is your outlook for China specifically?
Well, just on the US, I think incomes growth will pick up and that will support spending. I don't think consumer spending will be the main driver, but I think it will be generally supportive because it could do better than a lot of people expect. In terms of China, the economy has responded fantastically well to their stimulus program. Given how sharply exports contracted, the Chinese stimulus program was extremely effective in supporting Chinese growth over the last 12 months. Now, the fear that's in everybody's mind at the moment is, so what next? They're starting to tighten policy in some small ways already. Will growth suddenly abruptly roll over? I think that's most unlikely. There are risks because they are starting, as I say, to take away the punch bowl. But the broad-based recovery is still in place, and I would expect Chinese growth to be strong this year again.
Let's take a look then at the implications, as you see it, of a move to tighten now, because it also raises the issue of fostering a more sustainable growth path moving forward.
I think that's absolutely right. The worst-case scenario from a long-term investor's point of view would be that the Chinese authorities would do nothing, that they would let the economy continue to expand very dramatically, and therefore that they start to act earlier is definitely encouraging for the sustainability of their growth.
I was going through your report and a commentary and saying that Japan now boasts one of the few global markets that's actually offering real value right now. Let's go into the investment merit that Japan boasts at the moment.
Well, I think Japan is particularly interesting at this juncture because we all know that the Japanese economy has been a dreadful economy for 20 years. The stock market has been absolutely abysmal over that period. But does that mean we should have no interest in Japan currently? Should we just ignore it? The interesting point really at this juncture is that investors have lost interest to a great extent in Japan. That is reflected to some extent in valuations. But the important cyclical aspect of Japan is it's very operationally leveraged. So in recessions, profits at Japanese companies get hit extremely hard, but in recoveries they also tend to rebound very rapidly. So my general backdrop for markets will be strong growth this year, rising interest rates by the end of the year, and that environment typically has been one in which Japan has done well versus other regions.
Well, we've been very positive about the US and Asia. Of course, there are big question marks around Europe at the moment, of course, with Greece's debt situation really highlighting and increasing putting into emphasis the possibility of contagion moving forward overall. I mean, what are some of the key themes to dominate over the next while or the next year in Europe?
Well, Greece is clearly the sort of headline news at the moment. The Greek situation is very serious, and there are two issues really. First of all, there's a liquidity issue in terms of they have to refinance something like debt in terms of something like 20% of GDP. That's a very large amount. It's double that which Argentina was requiring to finance back in 2001. And we all know what happened there in terms of default and the crisis. So the Greek situation is serious. The second issue is the long-term fiscal sustainability, and Greece is going to face a very material long-term challenge to try to stop an explosive debt path, which is actually the path they're on currently. Now, the market is more obsessed currently with the short-term liquidity aspect to that, and I actually think what the European ministers are doing is quite intelligent currently, in that they haven't released any details as yet. There's no concrete rescue plan in place, but they're giving enough suggestions that there's implicit support for Greece there. And at the end of the day, this will end up being a game of confidence. If the ministers can generate sufficient confidence in the markets, then there is a possibility that Greece muddles through this crisis, and the other European countries as well, and the worst fears are averted.
Well, of course, with that confidence, still needing that boost. I mean, what's interesting in Ashburton's report is that you know that capex spending is likely to rise in the private sector, and to some, that would come as a bit of a surprise, wouldn't it?
I mean, globally, I think that's the picture. I mean, if you look at the US in the fourth quarter, capital spending in business equipment and software rose at an 18% annualized rate. I mean, not many people are commenting on that, but that's a phenomenal increase. In Europe, I think it's going to be more sector specific. So we could see pockets where capex is picking up, particularly in energy industry and other areas. From an investor's point of view, there'll be stocks in Europe that are less dependent on domestic growth, and that will benefit though if capex spending picks up around the world.
Well, there we have it, a bit of a global picture on the way things stand right now.